Welcome to TheoTrade. This is Don Kaufman. Wednesday, February 23rd, 2022. We are just seconds after the cash close here. Again, on this Wednesday afternoon, the S&P is once again down to the tune of about 1.75%. Nasdaq down about 2.5%. It's downright ugly. But what is of critical importance are levels that are being breached right here, right now, inside of the broader marketplace. Let me explain that and much more here on this evening's video. I'm going to try to give you a little perspective for not just right here and now. We're going to start with that. We're going to start with critical levels, again, that are being breached. But in a larger sense, I want to bring into scope, again, what I think matters most moving forward in a marketplace that is really being systematically dismantled. Let's of course start inside of the broader market, the S&Ps. This happens to be none other than an intraday chart. One of the critical levels that we have in place, and you can actually see kind of a faint line that's on the lower portion of your screen. Let me go ahead and put it into a daily chart. That particular line is, in fact, an extraordinary and critical level, a level that has been of critical nature all the way back since, into mid of last year. That level happens to be none other than 4211. That is specific, people, specific to the S&P futures. Now, futures and futures trading algorithms absolutely unequivocally have memory. What we are doing is not only testing into some of the recent lows from January, and of course we're retesting those. However, you have to actually pull up even more than a 9-month chart to see this. We're actually going to back it up, for instance, a year. We traded in and around, again, this 4211 handle for quite a considerable period of time. It was big reactionary high, big reactionary lows, but again, central place of trade was 4211. You will also see a period of time we actually ripped to the downside again just back in July of 2021, came down hard and fast right into that 4211, came down again, as I said, just more recently towards the end of January. A breach of 4211. One of the reasons I want to bring this into scope is this particular level, okay? It's not just about the S&Ps and or the SPX. The level itself, okay, represents, if breached, where volatility will unequivocally start to explode higher. And therein lies a considerable risk for the broader marketplace. Now, have we fully breached it at this point? Listen, we've come down just shy. I will suggest that the S&Ps are likely to hit that 4211, if not here in the next 10 minutes. Again, futures contracts are open, but an overnight trade, almost unequivocally, we're going to come down. We're actually going to touch into the 4211, possibly even breach through it. Again, the risk we assume is not so much the S&Ps. I mean, and this is where people go, oh, whatever, man. I got some positions on. They're getting killed right now. Yeah, but the real risk comes into play if we actually breach this level. And the real risk is when volatility starts to explode. So why is that a risk to you? You're like, I don't care. I own Apple. I don't care. I own this stock. As soon as volatility starts to explode, the market-making firms are going to turn around. What are they going to do? They're actually going to sell S&P futures in order to actually hedge volatility risk that they may be taking on board. In fact, one of the ways to actually look at this is if you take a look specifically at vol futures. And again, I'm going to bring you into what is termed contango and or backwardation. So this is something I've talked about quite extensively in a lot of the recent videos. And some people are aware of this, some people aren't aware of this. But normally, when you look at volatility futures, and volatility futures are under the symbol /VX, right? Those are your vol futures. Why are these so important? Why are they more important than VIX? VIX is not a tangible tradable product. VIX is nothing more than a calculation based on 30-day implied volatility inside of the SPX, right? So VIX is kind of my predecessor's volatility indicator. When you look at volatility futures, it's a tangible tradable product. So we have actually March volatility futures sitting at roughly 29.55. If you look at the volatility futures right after them, which would be none other than APE, the APES, which is April, is sitting at 28.40. All right, if we start to actually cross in the S&Ps through, again, that very fateful 4211, we got to get a little bit below it. So when you start to crack down to, for instance, let's throw specifics in here. You start to breach 4200, you should be nervous. You start to get for, and this sounds crazy, 41 like 90, that's when we're going to take off. What actually will occur is the March, okay, will amplify and actually split substantially away from this April. And the risk there is that once these two contracts, which were already in a backwardation, meaning that we're inverted, right? So short duration risk is actually exceeding longer duration risk. But if that risk gets any worse, these two are going to split apart. And what trading firms have to do is trading firms are categorically speaking, they're usually short here, okay, and long here, right? They're actually trading it for a contango. Well, as soon as this trade starts to split apart and go against them, what they do is to actually manage the short position here, they sell S&P futures. So the risk that you actually take is, again, critical market levels being breached. If the critical market level is breached, which is right around 4211, volatility inherently will explode. Volatility explodes, you get more sell-side activity inside of the S&Ps, will be off to the races. There's no telling when that wicked rip-your-face-off rally is going to come. Like, people, this is volatility. I'm just telling you what to prepare for, because if you sit here and you start to throw up MACDs and Fibonacci's and Bollinger Bands, allow me to be the first to tell you, none of that is going to be effective, okay, in a marketplace that is clearly, okay, being, as I said, systematically dismantled. Now, here's some of the darker side of the marketplace. One thing that is tangible, one thing that really bothers me, okay, specifically today, the volume in the S&P futures is dead. Why does that actually concern me? Does it feel like capitulation? Did you feel the fear on the street today? And the answer is no. You just looked at the marketplace and was like, oh man, it's going down. That's it. It's just going down. Again, systematically being dismantled. You didn't feel the fear. Okay. When I say feel the fear, I mean simply you didn't go in there and be like, that's it, I got to get out of here. Nobody felt that today. And it's one of the things we didn't see yesterday as well. But again, I can't reiterate this enough. You want to see real capitulation. You want to see markets freaking out. You got to actually back up a little bit. Behold, open up like a 3 year. Okay. There's some real fear, okay, and loathing in the marketplace back in this time frame here, which is ultimately, during, of course, the COVID crash. You want to see other, periods of capitulation. I'm telling you, spend some time. Look at charts, right? And the chart isn't so much what's important here. It's just volume, just trying to look at like, hey, when did volume really, if you will, amplify? When did volume spike? Well, again, it's not going to be a great indicator, but one thing it is a great indicator for is that capitulation is met by massive, massive volume. If you're not comfortable with the S&P futures, you don't have them, why don't you go take a look at the spiders? Okay, I think the spiders are really effective because the spiders, look at some of the hit that the spiders took just back here in the January timeframe. We did clear over 250 million, shares. Here, what are we? We're half of that kind of size. Does that feel like capitulation on the street? Of course not. And it's one of the things, again, if you're not comfortable with one product, look at another. Here's the COVID crash, which was clear up to, almost 400 million shares trading on a day-to-day basis. It's incredible. Okay, we're nowhere near that. And that's one of the points that I wanted to make in here. All right. So let's clear the slate from that. So the S&P futures critical level is about 4211. Crossing just through the 4211 is neither here nor there. It's when you actually start to get to that 4190-ish level where, again, the volatility will explode. For those of you that are a little bit more VIX-centric, what do I mean the volatility explode? If you're going to feel the fear, you see the VIX possibly up into the 40 handle, and it is going to, as I said, explode. It's going to feel like literally, okay, shot to the moon almost instantaneously when we start to cross through those levels. And that's when traders will really start to actually hit a little bit of the panic button. There's other signs in the screen right now that are a bit of a conversation piece. When I say that markets aren't necessarily feeling the fear, okay, take a look at the bond market. It didn't do anything today. It was actually down 19 ticks. One of the things that was also bothersome, okay, if this is marketplace, if these S&Ps are really going to get hit and hit hard, shouldn't we see a rotation from the S&Ps into the bond market? Again, you did not see that today. You did actually see a little bit of a fear trade starting to re-enter into the dollar. For those of you that have actually been around here a while, I am long dollar. I think dollar's going to explode higher. Okay, this is when people are the debasement of the dollar. Really? I just don't see that in this chart right now. What I do see is a world that when it gets scared moves into the dollar. Where are you going to go? I'm going to go to the Chinese yuan. You're probably not going to the Russian ruble right now. No. Where are you going to go? You're going to the euro? Absolutely not. You're going to the US dollar. That's when people also turn around and, then you get the crypto people out of the woodwork over here. Okay, crypto. This actually started the day relatively, well, it was 39,000, ended the day at 37 in change, right back to some of the recent lows. Crypto, I am a little bit more dire in terms of bearish in there. I think 30,000 is going to be in the cards here in the near term. I'll reassess some of the risk when we do get to that point in time. Nevertheless, let's again switch gears here a little bit. So critical levels being breached. One of the critical level that you have to actually have respect for, the SPX expected move, the expected move. Now, let me zoom into this here for just a brief and fleeting moment. The expected move this week, the EM equals plus or minus $121. We hit today. We actually hit the lower edge of the expected move in the SPX. It was 42.28. Okay, 42.28. We're actually closing what? Pretty much spot on. So not only do we have a critical level inside of the S&P futures, but you also now have a critical level inside of the SPX. Why is this so important? Because hedging can kick in and really drive this market into an absolute unequivocal tirade. By the way, look how perfect and symmetric, okay, this hit was. When I say this hit, we closed at the lower edge of the expected move. And I bring this to your attention simply in respect to the fact that it's a $4,200 product. You're in the midst of heavy volatility, and what does it do? Closes spot on. Okay. For the next 2 days of trading, that's it. This is a 4-day trading week, right? Thursday, Friday, got to watch this 42.28. If we start to lose the 42.28, again, not only are we going to crest below a major level inside of the S&Ps, but we're also going to kick in dynamic hedging and actually sell once you get outside the lower edge of this expected move. Again, if you get outside the lower edge of the expected move, all the trading firms have to sell into selling. So again, we are hitting absolute critical levels. Last portion of this, okay? One perspective I want to give you. People are looking at the marketplace right now, and they're looking at things like the spiders, and the chart, it's ugly. For the most part, we've given back gains for 9 months, but in a broader sense. And this is the time to do this. The market now it's in corrective territory. I can't stand that. Those marquee, it's a 10% correction. Nobody cares. I mean, really, nobody cares. You start to look at the QQQ, right? What have we really given back? We've given back 9 months of gains. That's it. We're back to where we were. We're back to where we were for the most part in June. That's it, right? So when I say that's it, 8-9 months of gains. This is a 9-month chart in here. What's the consideration at this point? The consideration is, okay, behold, right? This is a point in time where you really want to open up substantially longer periods of time, and you start to recognize this is a 15-year weekly. This is not meant to intimidate you. This is to open up your eyes, right? Okay, where this marketplace could actually go. Listen, we are still relatively unscathed. Start to look at stocks, individual stocks, even products like Tesla, okay, which is just a wild looking chart, all right? Evidently, not so wild anymore. You look at stuff like Facebook, obviously decimated to some degree. Apple, do you have cause for concern? I know I do. We have not begun to see sell-side activity in some really pivotal underlyings, one being Apple. Look at stuff like Microsoft, okay, which is, again, just a hop, skip, and a jump, if you would, off some of the all-time highs. Why don't you take a look at the financials, okay? The financials specifically, okay? These things are just a few days removed from effective all-time highs. Take a look at sectors like energy, which basically is sitting at or near its all-time highs. Yes, we have done and inflicted damage to this marketplace, but you cannot look at the near term. I really think at this point in time, you start opening up and max charts here in the spiders, and you go, wow, I get exactly what you're saying. To see us come back to even 250 on the spiders, not only isn't it out of the question, okay, we're on the dance floor for seeing a major breach lower in overall markets. Now, that's not to discount the ability to rally and rally hideously in days to come. Can you say that we're oversold in the near term? Unequivocally, we are oversold. It's downright ugly. But markets, okay, they tank from lows and breaches, okay, of specific levels precisely like we're seeing right now. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.